Hello, everyone. Welcome to Beers with VCs, where we have casual conversations about the less talked about aspects of the venture capital and startup building industries. We are thrilled to have Chris Harvey on our podcast today. For those of you who don't know him, he is the attorney for emerging managers, and his knowledge of the legal landscape for emerging managers in specific is unparalleled. From cap table math to keeping up with SEC regulations to QSBS stuff, he knows genuinely all of it, and he shares an incredible amount through his LinkedIn. But we're really excited to dive in today to some hot topics with him. So Chris, welcome. We're so excited to have you.
No, I'm excited to be here. And this is the Beers with VC podcast. So I do have
there we go.
Beer.
Let's kick it off.
Woohoo! What are you drinking today? Is it a fancy beer?
It is a fancy beer. It's the Radiance. It's a local Southern California Anaheim special. So yes,
very
it's
local.
DDH So Into You hazy.
Oh, that's amazing.
Nice. Can you show us?
How about you guys? Oh, sorry. Yeah, there it is.
Okay. Oh yeah, a tall boy. Cool. I like it. Nice.
It'll be a fun one
How about
today.
you guys?
I've got my favorite cardamom coffee today.
Oh,
Very excited. I know.
How many flavors have you got going?
I got all the flavors.
All the flavors. That's awesome. Okay.
Yeah.
I've been on a cheap beer stint. My wife and I are addicted to grocery outlet beer lately. So this is not the cheap fun beer. This is the Ninkasi Pale Ale.
Oh,
it's about
fancy.
$1 each, but it is
Nice.
very great. Smooth drinking pale ale. Yes.
That's great. Save on management fees.
There we go. I love it. For
Yep.
all our LPs out
I
there,
love
yes.
it.
Only
Cheers,
6
guys.
years for the next 10
Happy
years.
Friday.
Drinking very responsibly. There we go.
Amazing. Well, Chris, we have a huge topic to talk about today, very juicy. I would love to start off the day by talking about down rounds and the stats that we've been feeling as VCs about down rounds, and also the knowledge that you have. Can you walk us through some of the stats of the recent market?
Yeah, so it's a tough go out there. I think last that we looked at Cardo's and Cooley's data, they're showing that basically when it comes to C to Series A, the down rounds are pretty high. In fact, overall as a market, it's around 30%. Is what Cooley's data of all venture financing is around 30%.
Wow.
Now, when it comes to Series A, it's probably closer to 20, 23%. But we're also seeing a lot of down bridge rounds, which is a new term, right? So there's been and this, I don't think this existed maybe a few years ago, but because people are having trouble going from round to round, they're raising more on bridge financings. But because they're raising, at depressed valuations, what you're often seeing is valuation caps lower than the last priced round, just to bridge them to the next round. And so this concept term down bridge rounds is basically popping up because I think it's 30% or more are actually down bridge rounds in the interim. And I have one more stat for you, which is the companies that are going from C to A. If you skip doing a bridge, those companies are twice as likely to actually get a Series A financing, which is, I think, Sabrina, you're nodding your head, shaking your head up and down. It surprised me that you're not bridging is actually ends up showing in more success factors than actually bridging, which you would think would be the opposite, or not necessarily the opposite, but more in line.
Yeah, I think correlation and causation. If you're really a rocket ship, you don't need to raise a bridge, so it could be causal or whatever. But yeah,
exactly, exactly right. Yeah. And so the other stat that I wanted to show, and I think you have a heat map that we showed before. What you're really saying, this is kind of a complicated heat map, but just to distill this down, what you're looking at is you're looking at cohorts between 2018 and 2022. So on the left here, this is if you raised in 2018 in Q1, you'd be all the way at the top left. And if you go to the right, this is time. So each column represents 1 quarter. So if you go to 8 quarters, where it's highlighted in red, this is your 2-year mark. And this is kind of what a lot of people say, by year 2, you should probably have a good idea of if you're going to raise the next round or not. And this is from C to A. So if we look all the way to the top in 2018, about 31% of that cohort was raising the Series A by year 2. And going down the line, it actually starts, kind of goes down a little bit, but it picks up in 2019. And then boom, 2020, it goes really, really high. So 40%, if you go right in the middle where the 40% in 2020 is showing, basically if you raised a seed round in 2020, in 2020, by year 2, which is 2022, those companies were, companies in that cohort were getting 40% close of their Series A. So almost like half, right, of the companies were doing it. And by year 3, it's definitely almost half, all the way to the right. Now, the problem you're seeing is like, if you keep going down the years, so if we go 2021 and then 2022, that number drops to like 20%, and then all the way at the bottom is 15%. So what does that mean, 15%? It means that if you raised a seed in 2022, only 15% of those companies, those seed companies, were able to get a Series A by year 2. So that's like, it's a huge drop off, right? And the way this is color coded, it's basically saying it's really hard right now to raise. Now, there's another stat that I saw where they said that like the ratio of going from C to A eventually is 5-1, which means you have 5 seed companies for 1 Series A seed. Which means it's just a crowded space, right? Seed valuations haven't really gone down. If anything, they've gone up. But there's a big jump. I think the median pre-money valuation for a seed company is like basically $15 million. And the pre-money valuation of a Series A is $40 million median. So it's like a big jump from C to A. And it just means there's like less room for those A companies to get through.
Yeah. I did want to flash this other chart that we were talking through earlier. A very sobering image of the number of, seeds versus A's. Obviously, we had the huge spike at the beginning here in 2021, 2020 area. And now we're crashing back down to, honestly, course correcting probably appropriately relative to what it should have been anyway. But just really interesting to see these stats.
Yeah. So I mean, just because it just goes to show it, even if it's relatively, even though the valuations haven't really changed much, if anything gone up, the availability of capital as you move up the rungs just becomes harder and harder. And so you're seeing that, in fact, from Series A to Series B is actually much, much easier. I think it's like a 3-to-1 ratio than it is going from from C to A. So.
Yeah. So sobering times in the world of VC.
The ratio, though, for seed companies is actually improved here, going from C to A, right? That's what this is.
No, so basically this. So there's another graph that shows you the exact ratio, but it's actually gotten worse for the Series C companies going to Series A. So yeah, if you're pre-seed, it's gotten better, right? Because there's more seed rounds. Or I shouldn't say there's more seed slots. There is availability of capital at the seed stage. Mm-hmm. It's just once you have the seed going to A, it's actually gotten worse over the last several years. Since 2021, I should say.
Got it. Even though on this graph they look closer, the ratio is worse. Like it was.
Yes.
I think another assumption on this one is like there's a little bit of a lag between like the seed raise and then the Series A raise, and so that's not true. You can't just like subtract vertically in this chart.
You can't just go vertically. I see. Mm-hmm.
Yeah.
And the trend for the A doesn't look great.
Yeah, I mean nothing looks great right now, but
nothing looks great, but yeah. Mm-hmm. So I mean, obviously, what this is doing is it's pushing companies to bridge rounds, right? So I think that. The activity in the bridge space has like really gone up, but it doesn't, as I said before, it doesn't actually meaningfully improve. Well, I shouldn't say it's causation, but we're seeing that the companies that have bridged are not really raising on the Series A, right? They're running out of money effectively without being able to cross over into the Series A space. So what this means is just like a lot of pain and a lot of down round activity, and so you mentioned earlier, there's like some sort of like correction. I think there is a reversion to the mean, because if you look before pandemic, these valuations were a lot lower. You're probably going to see a little bit more aggression on pricing. It's also like kind of the natural result of this is it becomes more investor friendly environment. And so, what may have been, and the tactics that go with that, I mean, we could discuss it, but it's like, I'm seeing definitely more, in my limited view of the industry, I'm seeing a lot more investor friendly terms.
Yeah. And I think that's been a lot of the emerging managers' pitches right now, is that we have really good terms. LPs give us money because we can get some really good deals right now. But I think there are still tools out for founders to, be getting back equity inside of these companies despite the current macro. You mentioned the option pool shuffle when we were chatting earlier. I would love to dive into that. And can you explain what that is and how that works?
Yeah, so the option pool shuffle is actually something that came up many, many years ago. It was Nivy, and so he basically came up with the idea that like the option pool shuffle is, you will get a term sheet as a founder. You'll get a term sheet that says, hey, we want to take 20% of your round, but we want you to add 20% to your option plan before we invest. And so you can't just really say, okay, I'm just going to take that offer as though I'm having $8 million pre-money valuation, right? Because even though on paper your pre-money valuation will be $8 million because the investor's investing 20%, they'll be getting total post-money of $10 million. What happens is you actually have to subtract the option pool from your pre-money to get what's quote unquote your effective pre-money valuation, which is actually what you priced your company at. And it's almost always that you're going to price the option pool in the pre-money, even if you expand it, if you do anything. So it ends up like it's a surprise dilution hit that most founders, especially when they start off, just aren't expecting. Mm-hmm. And we can go over the numbers, but like if you know one thing, like the option pool shuffle is like definitely probably the most important and most common way that investors can affect the pricing.
Yeah. I'd love to go through a term sheet example, and I know that you already have a really beautiful spreadsheet prepared. So let me walk through this one that we pulled up earlier. So just to contextualize what this actually looks like in real terms, Chris put this amazing example together for us. So I don't know, Chris, you want to walk us through the layout of this type of example, highlight the option pool, and then we can dive into the numbers.
Yeah, so this is just like the standard NVCA style term sheet. NVCA obviously has like their open text, which is the NVCA financing documents. And so the first thing that you're going to get as a offer is going to be on through your term sheet. And so this just says what you're getting at the price you're getting it, and then any other terms that like are control terms or economic terms are going to be in here. So up at the top, it says we're doing a Series A preferred. In the amount raised, or I'm sorry, in the investment amounts, it's going to say, hey, this is how much the lead investor is taking. So here we put $5 million. But there's also like the fact that maybe you had some bridge, you had a bridge round or two. And so you want to figure out where you're going to put those securities at in the pricing. So you can either put them in the pre-money or you can put them in the post-money. And so we'll go over like the calculations here, but like think of it this way. If you have $5 million of safes, is that going to dilute the new investors? Meaning, is it going to be counting in the post-money? Or are you going to say, actually, the investor's going to say, well, I actually don't want to be diluted by those safes since we weren't part of that. You're going to put it in the pre-money. And so those two methods are like the pre-money method and the percentage ownership method. Now, everyone always thinks there's like one way to do a cap table. And so I think like having done this for several years, I've just come across so many surprising things you would just never expect in the negotiation. Probably like 20 to 25 to 50% of the time, it's just people not knowing how to do things. And then the other time, it's just like misunderstandings or a lot of times ambiguity. And so what the term sheet's supposed to do, not always successfully, but the term sheet's supposed to very clearly identify how you're calculating what. And if like there is any ambiguity, who gets the dilution, who doesn't. So this one says very clearly the price per share of the Series A is going to be based on the fully diluted post-money valuation of $25 million. that gives you a clue that we're working with post-money valuation. And so we're basically going to take the maximum value that you're going to include in the cap table, and that's going to be your target. So we know, like, it's very simple from a mathematical perspective, like what the investor's going to get, because you're just doing basic math. So if you're putting in 5 million as the lead investor, you're going to do 5 divided by 25. You're going to get 20% of the entire round, right? So when it comes to the other most important part is the option pool shuffle, which is like here we put 13% of the fully diluted post-money capitalization. So again, we're counting from the tail end of the 25 million. And so what is the option pool going to look like at the very end? It's going to have 13% times 25 million is going to be reserved for the new option pool. So that's pretty much that. I mean, that's the economics part of it. Now the rest of the document is going to be on there might be other economic terms, but like that, the price per share is the most important term. And as far as economics goes, is the most important term. Everything else is just like, support or ancillary. Liquidation preference is obviously very important, but generally speaking, you're just going to have 1x non-participating, which is just like the standard way of doing things now. Even in an environment that's like super investor friendly, you just don't see that really moving. Maybe at the later stages, but in the seed and A, like you're just not going to see. It's a pretty big grab if you're getting participation rights or you're getting more than 1x as an investor. Like you're being very aggressive in that stance.
Interesting.
I want to
definitely
go for it, Simon.
Definitely later stage. I've heard a lot of later stage firms or startups where they have those terms.
Yeah, liquidation preferences.
At which stage, like B and C, it starts to become more.
Yeah,
common, right?
yeah, you'll see it in B and C for sure. But the other thing you'll probably see is something that's like maybe not as. If you scroll down a little bit, I'll show you. There's so many ways to skin the cat, but like scroll down to dividends. Okay, this is a good one. So dividends is actually something that no startup ever issues, or if they do, they get like front page of TechCrunch because they issued a dividend, right? So you're not expecting them. So they're never issued, or they're never paid, I should say. They're never issued or paid. But you can actually add, as an investor, you can say, hey, I want cumulative dividends. They're going to pay out 8% per year on my shares. So what you've done there is effectively you've put like an interest rate on your money, and that interest rate gets paid at exit before anybody else gets paid. So it's kind of like it's like another way to get like liquidation preferences without calling them liquidation preferences. It's just 8% flat, over the course of your investment. That's also a pretty big money grab, when you're doing it at the seed round. So all non-cumulative dividends means is like, hey, if you guys do actually issue dividend, we're going to get 8% on top of what you're paying out, just as a preference. But again, these non-cumulative dividends are almost never issued.
Rare.
So it's super rare. So yeah, and the rest of the stuff is just like control rights, which we're not really going to go over today, but just information rights, control rights, what you get a veto on, basically. And then who gets to be the major investor. Major investor are going to come with a host of rights that go with it. Anyway,
and a side letter defining those rights, Chris, typically.
So good question. Typically, you won't have side letters. I should say that. Yeah, if you have an open safe, yeah, you might have a side letter in there. But the intent of doing the price round is really to get all those side letters and like move them onto the investors' rights agreement, or at worst case scenario, like a side letter in connection with the price round, because they just don't want random, safe side letters out there for like in perpetuity, because the safe gets converted at the price round. So you shouldn't have a safe side letter in the next round.
Makes sense. Okay.
So I think going back up to the numbers up here, to contextualize the key pieces, I think we'll kind of lean into today. The most important things here are if this is going to be calculated on post-money versus pre-money. You mentioned, Chris, right? One of them is very favorable to the founders. One of them is very favorable to the investors. Post-money, as you've described, is favorable to the investors because the amount of equity that the investors are asking for is pretty much set in stone, and everyone else gets diluted relative to them. So that's like number one. And then number two, I will be running through this in I think your Excel spreadsheet example, but can you speak a little bit about like what typical numbers for these option pools are and at what stage people start introducing these? Is it like they will do this at the A and at the B and stuff like that too? Or is it, how does that typically look?
Yeah, you're always going to get diluted some amount from your option pool expansion, only because you typically have new employees, and those new employees are going to take up, the option pool that you have. And just as a natural progression, as you grow as a startup, you're going to have more people that need equity. So you kind of need a bigger pool as you continue to go through the rounds. That pool, the way VCs think about it when they're issuing these term sheets is they want to know what's available. They want to know what's new, what's fresh. If you have an option pool and you've used all of it up, it just doesn't really do any benefit for them. So the way they'll phrase it is one of two ways. They'll say, we want an unallocated and uncommitted option pool, and those almost always say it in the post money because they want to peg it to like their investment. So they want to know how much their investment's going to get and then how much the option pool is going to get. Because also when you do an option pool expansion, especially on pretty much any way you slice it, the investor does not get diluted on the option pool, but the founders do, right? And that's part of the option pool shuffle is you're pricing the option pool expansion in the pre-money. And so investors obviously have an incentive to keep that option pool number higher, and founders have an incentive to lower that because that's going to come at their expense, out of their pocket. So kind of this balance between the investor kind of having a higher pool and the founders having a lower pool is basically planning. So having some sort of model, you can do like a hiring model or anything like that to show both sides, hey, this is what we're planning on increasing our headcount, our full-time employee headcount, and this is what we're allocating for those future hires, and call it over the next 2+ years. We expect to have this many hires with this many needs on the option pool, and then the VCs can say, okay, yeah, like maybe I wanted a 15%, but what you laid out is like a 10% option pool expansion. Like we're good with that, and so that's how you get the negotiation started.
Yeah. I'm very excited to dive into this example. I'm also interested to walk through how this influences the founder equity and VC equity in up rounds versus down rounds, which I think we're about to dive into. But definitely we'll keep this one in mind. We'll circle back to this topic, I think, throughout our conversation right now. Okay, cool. I'm going to stop sharing this. Okay. And let's go through your example. Does that sound good with actual numbers?
Let's do it. Yeah.
Woo.
All right. So this is a cap table I put together. It's going to have, there's variables that you have to just hard code into here. So over on the left here, we have a dashboard. I basically hard coded what looks like, founders at 80%. This is in like the formation stage. And so they just have a very clean 10 million shares reserved or outstanding. And they've issued 500 shares as part of the option pool. So total pool of 2 million. Founders have 8 million, a total of 10 million shares that are outstanding. And so, effectively, we got to put some numbers in here. They had a pretty decent seed round, 3.5 million, and the investors got 20% of that. So post money of 17.5. But then when we got to the bridge, they thought they actually could go with this valuation cap of $40 million is what a Series A would normally have. I think the median Series A investment round is at 40 million pre, right? So they're putting on the valuation cap. Now, a safe actually, most safes are, you can do a pre-money safe, but most safes today are done on a post-money basis. So the valuation cap of $40 million is actually pricing the company at 35 million. So it's a 35 plus 5 is 40 million. That's what the safe holders are expecting to get. That's actually, I should say, that's what the founders want, right? Is a high valuation at the next round. And so we get to the Series A. That's what we're looking at today. We're looking at Series A, and so 5 million being invested in the company, and the investors getting 20%. That puts it at a post-money valuation of 25 million. Now, this number is actually can change, and we'll go into why it can change But the way the term sheet read, it'll never go more than 25 million because you're doing it on a percentage ownership basis, and so you're always going to. That's also just going to be a fixed number. It's almost like you're fixing 25 million. We have to figure out what everything else is for them.
Mm-hmm. Pausing here.
And then,
so like this was the case. Basically, this kind of reads like a company that was founded in like 2019, raised a stellar bridge safe in like the 2021, 2022 era at a ridiculous valuation of 40 relative to their appropriate stage. And then, they've spent another 2 years trying to build the company. They can't actually meet that valuation. They have to lower their valuation to 25 in order to be able to get more capital to keep the business moving. And so like the dynamics here, unfortunately, this is the exact scenario that we're kind of seeing play out in all the stats we reviewed at the beginning of the podcast, right? Like all these companies that are really struggling to like get to the A. I think their criteria for raising in the 2021 to 2022 era, most people like didn't even care if you had enough revenue, right? At that point in time to be able to underwrite your valuation. They're like, if you have some indicators of traction and we have friends that'll invest at this valuation, like we had no problem doing this deal. But in today's day and age with, 2024, we're seeing that, everything's kind of crashing back to reality where it needs to, the amount that you're able to raise and your valuation needs to map to the amount of revenue you're able to get. And what we're seeing in today's market is that just candidly, $1 million in ARR is like what the minimum you need to have in order to be able to raise like a true A in this market. I'm curious, Chris, if you've seen the same thing. But 25 post money is a lot more reasonable relative to the 40. So wanted to contextualize like from a VC standpoint as well. This is like what we're seeing, and unfortunately, this is what's playing out. So now we can go into the math behind it.
Yeah, for sure. So this is just like the inputs. There's a little comparison here, but like we'll just like jump into the percentage ownership tab. And so this is going to be on a post-money valuation. And so we have the same inputs here, only that we just have the leading up to it. We have the pre-money valuation, post-money valuation, and seed round. Since there was only 10 million shares issued in the formation, investors got 2.5 million at the seed. And so we're now at this stage. So we're at the seed, 12.5 million shares have been issued, but we actually did something in between the seed and the A. We did a safe round, right? And we did a safe round at $5 million with a $40 million cap, and importantly, a 20% discount. So there's no especially actually when you're doing a percentage ownership, there's no really hard and fast rules. But if you were doing a pre-money method, which we'll go over a little bit, there's like a heuristic to see whether the discount or the valuation cap applies. Because I would guarantee you, like how many times I've seen this, what people always think is the discount applies on the valuation cap, right? So they'll take 20% off of 40 million and apply the discount, but that's not actually how it works. Yes, it's very bad, which is why we always put discount PPS, right? Price per share. So the discount is 20% based on the eventual round's PPS or price per share. This number, I probably should just highlight it because it is by far the most important. This is the only number that doesn't lie on a cap table. Like this is, I can't even tell you like it factors in like conversion ratios. If you have a true down round the next time, this is the number gets looked at, right? And so it counts as your conversion ratio. It counts as your what your stock is worth. I mean, is the most important number on the whole entire cap table, and it doesn't lie. Meaning, you can actually compare price per share from different rounds, and it's like you're comparing apples to apples. But when you talk about valuations, that really you can't really compare that from round to round because the number of shares changes and the allocations change, and so it doesn't really mean anything. But the price per share is ultimately what determines ownership and dilution. So it's extremely important. So why did I go on that rant here? Because the discount applies to that number. So you're taking 20% off 95 cents. And the discount price per share is 76 cents. And the way the safes work is you're going to get the better of the two. The valuation cap price per share is $3.20. And why is that? Well, because you're going to take the valuation cap and divide that by your company capitalization, which is, I put on here is M21. So your fully diluted capital, right? And so it's not gonna drive you the returns that you need, and so you're going to apply the discount. And that ends up doing is the safe holders end up taking 25% of the rounds, even in a percentage ownership basis. So for the lead investor, they don't really care how the safe converts, right? It doesn't really affect them. So the fact that the safe holders are getting 25%, it doesn't matter because they're putting in $5 million on a 25 post, so they're going to get 20% no matter what. And so these are the two lines up here that show the Series A investor. That's who's writing the lead check for $5 million. So you can say that the safe holders actually got like an effective discount of 5%, right? Because they put in the same amount, which also makes sense because they're getting a 20% discount, right? And so the absolute discount they're getting is basically 5%. So $5 million in exchange for 25% for the safe holders. $5 million in exchange for 20% for the lead check writer, the Series A investor. I went through that pretty quick, but
I think that's really good. And I think one thing I do want to double click on. So the Series A investor doesn't get screwed in this situation. The safe investor is more or less fine, but the founders really take the hit here, right? And I can pull up the other chart. So you can see that the founder ownership here in the Series A post is 30% ish. So I'm going to share another table that we have prepared for founder holdings. And this is something that from the VC standpoint, we, as emerging managers need to be very cautious of because we need to ensure that the founders are appropriately incentivized to continue building their companies and making sure that they want to keep working. And this chart really outlines a healthy case for a founder to be in terms of equity versus a very unhealthy case. And so the example that we just walked through was that they're 30% at their Series A, which already is kind of in, sketchy territory from a ownership standpoint for them. Much more comfortable is obviously in these green ranges. And so while it's not particularly negative that the VCs themselves didn't get diluted inside of this deal, it's very important to understand that if your founders are diluted to a point where they can't be incentivized to have enough equity when they exit, they're not going to want to keep working on the company. You're going to have, personnel issues potentially, or something needs to change basically. And so that's actually, I think, Chris, we were talking about where the option pool shuffle really can make a big difference here. So I'll let you share your screen back. Let me move that back. But
yeah, that's a good point. So, I mean, this is where dilution can really get out of control because what we have right here is we have, we're calling this the ESOP. I think it's like the normal way to talk about it, which is ESOP issued. So these are 500,000 shares that are going to employees already. And then we have unallocated, or, the other way you could say is uncommitted or available shares, right? It's 1.5 million. So this is actually in the pre-money. There's 2 million shares issued in the plan. Now what we're looking at is the top up, right? Because we're trying to see the investors' worksheet had 13% allocated, but let's just say it had 20%. It said, we want 20% to be available in the post money, which I've seen before. And if you don't push back, this is what's going to end up happening, which is the founders went from owning 30% down to 25%, right? So it's a pretty big hit on the founders. Every percentage point you increase on here has a pretty big effect on their share percentage. And so that's why this almost always gets negotiated, unless for whatever reason, there's, there hasn't been many shares issued, or this is the first option pool being granted. This number is going to go down from 20%.
Can we talk through the dynamics of why you would why wouldn't a founder then just have this be as small as possible and try to negotiate as small as possible versus the other case where they would want to make it extra large?
Yeah, 2 reasons. One is just because it's very common. I would say it's very common to have an option plan expansion. And so if the founder said, "Hey, I don't want to I don't want to do that," they have to kind of have a reason why, because it goes against the grain, right? So usually what you would do is you'd say, okay, well, if you don't want to do 20%, tell me what you have in your hiring plan, or tell me what, like, what we've seen in the past is we expect, 10 to 20% to be available. And so, the founder's going to have to come up with that. They're going to probably have to have a good reason. Otherwise, the investors just aren't going to invest. And it'd be kind of weird for founders to push back and say, basically, we don't want an option pool expansion at all. I've seen that happen. Doesn't usually turn out too well. And also, it also shows a little bit of greediness, right? Because these are your employees that you're incentivizing. This is not like, this is not to you, like, personally. It's like to everybody. And so, there's just some expectation that you need people to come along with you. You just can't be the two founders in the company.
Yeah. So yeah, it's the mindset of a healthy founder realizing they want to grow their business and attract people to help them build whatever they're building, that you need to have some kind of option pool. Now, if you're this founder and you're stuck in the situation where you're like, crap, I only have 30% in my Series A, given the fact I had to raise that like crazy bridge round, like, do they have any options for course correction at this point? Like what can be done?
Yeah, I mean, we definitely can. There's definitely ways to do this. So like the biggest way to do it is to say, if you end up with like a smaller percentage, than you were expecting, there's like a top off we can do, right? And so the founders can get an extra, in some cases, an extra percentage on the option plan, because it'll allow them to have maybe more in the range of what a non-broken cap table looks like, what a healthy cap table looks like, I should say. And so maybe at the seed, you're not going to get 50%, but maybe they say they want 50%, for whatever reasons. And so what ends up happening is you'll have to take that as part of the available options. I mean, these are called promised options, so they're not truly available. They'll count on the pre-money, but you would do the same calculations to see, like, okay, how do we get them to, how do we get the founders to be where they need to be at? So you can just take the post plan. Okay, so it's 47%. So you'd end up having to like do a 42%, 48%. Well, yeah. The numbers are just not working, because it ends up being like, basically ends up being too much to do there. And we go back. Oh, I broke my cap table.
Chris, can we share this spreadsheet, or what's
yeah, totally. Yeah, I'll make it available for sure.
Okay, great. Then we can post it in the comments below the video.
Yeah. That's good. Awesome. So that example is extremely pertinent. All of that, though, was inside of the percentage ownership model. What does it look like for the pre-money model?
Yeah, good question. So we go over the pre-money method tab. Again, we're starting with the same assumptions in the seed, same assumptions in the bridge, and then the Series A of 5 million and 20%. This is where the price per share it's gonna be affected, because we're only going to be including the pre-money shares, which is the 12.5 million that you raised in the last round, and then including the option pool expansion that's going in this round. But we're not going to touch, and we're not going to include in the price the shares that are going to go converted from the SAFE. Because if we included the shares from the SAFE, then it's going to drive this price per share down. And in fact, you can just compare the two. I think I have it here, yeah. Actually, let me go back to the percentage ownership. So the price per share here was 95 cents per share. And that's because it included all the 6.5 million shares from the SAFE. And that's why the price per share is too low. That's actually beneficial to the investor. So in a pre-money method, which is you're ignoring what's on the SAFE, and you're saying, hey, you actually count it in the post. And so you have to count the number of shares. So the post-money valuation is actually floating. It'll be floating by the amount that you're raising on the SAFE, right? So whatever the value of the converted SAFE is, you're going to add that to your post-money. But your pre-money is fixed. And unlike the last conversion that we did, which is you're fixing the post-money valuation, in the pre-money method, you're fixing the pre-money valuation.
Right.
So the way I think of it is like, it's it's like a T. You have a T, and you need to put like some shares on the left side, which are going to go in your pre-money, and some shares are going to go on the right side of the point you're fixing in time. And the point you're fixing in time is really immediately at the last round's number of shares plus your option pool expansion. And so that number, or those two numbers together, are going to be they're going to be your fully diluted pre-money capitalization. So that's a long-winded way of saying this is very founder-friendly to do the pre-money method. And I would say, like, certainly like in 21, and certainly in like the pandemic time, like the pre-money method was ubiquitous. Like everyone was doing the pre-money method because valuations were going crazy and everyone was just riding the wave. And so like pre-money method made sense. But since then, I've seen actually a big switch, and I see a lot more percentage ownership conversion methods. Because why? It's more investor friendly, right? So that's what I said, with these down rounds and like, everyone vying for that one slot, 5 seed companies vying for that one slot in the A. Investors are going to have a little more elasticity in what they can offer. And so they're going to say, well, I want a percentage ownership or post-money like calculations because guess what? It's better for me. And at the end of the day, like I'm the one driving those decisions. Now, where does the pre-money method make sense? It really makes sense in 2 scenarios that I can figure out. One is just if the company's on a rocket ship, it's like they're just going to the moon. Like they're going to say, hey, we're doing the pre-money method, and that's either you're in or out. The other way is actually at the bottom end. So like the very top is going to use the pre-money method. I usually see that almost always. But at the bottom, what I've seen is actually VCs being like, you know what, you have such a bad like economics when it comes to these conversions. We're actually going to give you the benefit of the doubt, and we're going to give you the pre-money method for your shares. Because if we don't, you end up being with like just a wrecked cap table, and we don't want that. So they'll almost like do founder friendly, only because to do the opposite would be like, kicking someone when they're down. It's just almost unfair.
That makes sense. And it ties back to the fact that like as VCs, we need to be cognizant of the founder's equity as well. We can't just bulldoze them down because then they can't actually build their own companies. So that makes complete sense. Yeah. Why isn't price per share like more widely shared on term sheets? Like, is that
because it's confusing? And so like I said, I think a lot of people, and there's some incentive to obfuscate this, meaning like hide the ball when it comes to like how things are calculated. Like I've been in so many valuation, I call them arguments, I guess, where like clearly like the investor or sometimes the founders tried to hide what they were trying to ultimately try to do. So you'll see it in like 3 places. You'll see it like, they'll say, well, like the pre-money valuation is this and the post-money valuation is that. But then they don't tell you they actually want to, hide some like promised options. Because promised options are almost always in the pre-money, meaning it's like it should be to the detriment of the founder. If you have like this rock star CTO that you want to bring in on the Series A, and you're like, hey, we'll give you 20% of the round because we're getting like 20% on our target pool, and then you don't tell the investors that, potentially like that's like drawing a line of like, you're misrepresenting, because promised options are supposed to be counted as granted, right? So if you say, hey, I have the CTO, I'm going to get 20% to you, they say, great. That doesn't include what we're asking for, which is really you're asking for like a 33% increase in the option plan, not a 13% increase, because you can count those shares too as part of the pre-money.
That's super sneaky.
It is sneaky, and I've seen it gone both ways. So what I try to do, there's 2 things that you just really have to do. Number 1, try to be clear about what your intent is. And 2, realize that almost always, very rarely do I go through a cap table and be like, oh, we totally understood like exactly how that was going to play out. Especially with like complicated cap tables and like these weird pre-monies, and then you get like fixed percentages. Like it all just gets like, it's just like, I wish there was an easy button for this. Like why is Chris like building out these cap table models? It's not because like I enjoy doing this, I don't. But like if you run this through like a platform like that says, we have the easy button, you can just hit, convert, and like we'll take we'll take it off your shoulders. That's just like, to me, that gives me nightmares, because I've seen so many people not understand how to do this. Even like really, really intelligent, very smart. It's just like an experience level. If you haven't done like 50 of these, you probably are missing something right along the way. And so how do you find that out? You make the mistakes like I did, right? You bumble through it and you kind of realize, oh, I probably should have figured that one out. Or B, you try to read up on it. Right? That's kind of what we're doing right here. And so what I would say is like my number one advice on all of this, like if you take nothing else from this presentation, it should be this. Always, always, always do a pro forma cap table. Freeze at the moment in time. Include everything you're going to be issuing, but make sure you do the pro forma. And the pro forma cap table is really like literally going from step A to step Z, final completed cap table, what that looks like. That can take a week or more to build, right? I've been with companies that's taken longer. So I would say like get on that early, understand your metrics, understand what conversion method you're going to be using, understand exactly what you're going to be issuing, have the hiring plan ready to go. And that way, when the investor comes in, there's like no second guessing on what you're looking at, because that will hold up the round too. I've been in situations where like either the attorney didn't know or the founders didn't know because they hadn't done the homework on like how their cap table is eventually going to look, and it slowed down the rounds, and it causes like all sorts of like what's going on kind of questions. And so the best thing to do is just come prepared. That's all.
Yeah. For those like softwares that claim to be just like plug in the numbers and chug, I mean, we've even seen like just in the example today, like there can be misinterpretations going from term sheet even to Excel spreadsheet, or not misinterpretations, but like different interpretations. And so it's incredibly speaking with you, Chris, about this on a couple of our deals as well. It's just incredibly, incredibly important to have someone that like understands how to do that transition appropriately, and that you're not missing anything in the legalities of all of this too. The perception I mean, is like it's just Excel spreadsheet numbers, but in reality, there's so many smaller nuances that exist.
Yeah, I mean, eventually, like this will probably get automated to a certain point where like you don't need to actually do, the calculations here. But what you really need to be aware of is like how it all works, right? And so if you have a really good structural understanding of like how this all works, then you could probably use something that's automated that is 100% correct, that you've experienced before, to do the number crunching for you. But the other problem is like sharing that result. So like the reason why everyone jumps in on Excel sheets is it's very shareable, right? You know exactly what things change, even on Excel, even though it's like you can still like figure out where they did their math. The problem with some platforms, not all of them, is they don't show you the math. They'll spit out a model and you're like, how did you calculate that, right? And there's actually like different ways to do this. I always thought that like cap table math was kind of like this, like, black magic, but it really is all just algebra. It's like literally algebra, right? Like 7th grade algebra is what it is. And so you can actually, I've done this. I have an episode on this. I published where I actually went through and just did only mathematical equations, no cap table, circular references, just the math. In fact, how do these platforms actually build a model? They're using math. They're using algebra, right? They're actually using the formulas to get there. And it's not just a circular reference, like, where cap tables can break and everything. They actually have like precision down to the exact decimal point where they need to be. The problem with that is like showing the work for that is like extremely difficult. So the reason why the Excel format works is it's like easy to share. It's easy to see what you've done. And you don't have to these like complicated algebra equations where you're like, I don't like really know how to do this. And so, you can kind of cheat a little bit by using the circular references, but it gets the same result at the end of the day.
Yeah. And you have fantastic blog posts on this already. We'll link the couple that you're referencing, after this podcast to the group. But is it like episode 8 or something was that the one you
that was the first one. Yeah, that was percentage ownership. And then I got one coming out that's going to do pre-money method.
Nice.
I'll probably do both, but yeah, pre-money method. I don't know if I'm going to do the math. I don't know. It's a lot of work.
Yeah. And like showing it in a blog post format, also very challenging. Yeah. When I was working through examples, I literally have like my stack of papers that I've been like, I haven't had a stack of papers and done equations since college. And it is, lots of fun. Yeah.
Just want to give a shout out there for your Substack, Chris. It's extremely, extremely helpful. It is, it's insane like how helpful it is. If for founders and emerging managers. I highly recommend subscribing. Chris has over 3,000 followers on the Substack already, or subscribers.
Yeah, 3,500, but who's counting? But yeah,
Nice.
Law VC is the Substack. So
That's great.
yeah, I mean, I basically, the reason why I did that is just because I made these mistakes, right? I've been doing this for 15 years, 10 of it in venture, really, and like I made a lot of mistakes, right? So it's just like from learning those mistakes and then like realizing actually other people could avoid these mistakes if they read up, and so that's why I put it up.
Yeah. Avid reader. I'm definitely going through all of your blog posts and studying up, making sure. Yeah. It's a fantastic resource.
So
cool.
yeah, I don't have anything else to say on this pre-money plan, but yeah, maybe we should just do a quick overview, just kind of like level set of where everyone's at. So let me see if I can. Yeah, so you can kind of see side by side. So in a percentage ownership method, I got these. Yeah, there it is. Okay, so founders have 30.55% in the percentage ownership basis, right? Actually, I think I did these wrong. I think this is actually backwards.
It's flipped, yeah.
Oh, you know what? We changed our numbers here. That's why we can't end up doing that. The comparison.
Oh, yeah. Sorry.
The point I was trying to make is, because we changed these numbers up.
That's fine. We can just look at
in
the
case.
last column here. Yeah.
In any case, yeah. So doing the percentage ownership, you're going to end up with like a worse scenario for the founders than doing the pre-money method. But at the end of the day, like unless you're like a rocket ship, like I said, or like really, really hurting, where the VCs are basically taking pity, on the parade and saying pre-money method wouldn't make sense here, you're probably going to be using some version of both, but really percentage ownership. I'd say in this day and age, we're seeing a lot more. I still think pre-money methods maybe, I don't know, like 1 to 4 rounds that I see. But I'm seeing and I'm doing it at the early stages. So most of my rounds are pre-seed, seed, and Series A.
Mm-hmm.
And I would say it's a lot more common to see percentage ownership today than it was even like 2 or 3 years ago.
Yeah. That's super helpful, Chris. So if you can't tell, audience, like Chris knows literally all the things, as I mentioned in his intro. It's been hugely helpful just to like walk through these examples. And underscoring too, like your understanding of how the legalities can be interpreted in different ways is incredibly important when figuring out all this math. So really appreciate all of your help in that regard for our deals, and hoping that you can keep spreading the word with all the other emerging managers as well.
Thank you.
Mm-hmm.
Yeah.
Very cool.
All right.
Okay, so we'll definitely share this after. Yeah. Mm-hmm.
Perfect. Yeah. Well, I'll share it up with you guys, and also maybe the term sheet as well, because they kind of go hand in hand.
Yeah, absolutely. Sweet. This was super fun, Chris. I want to spend the last couple minutes of time getting the audience to know you a little bit better. One thing is that obviously you've dedicated your present law career to emerging managers, and I'm curious, when you started out in this industry, how did you get your start, and who was the most impactful person in your career to date?
Yeah. So, I mean, when I graduated law school in 2008, it was like pandemonium. No one was really hiring venture capital lawyers, I can tell you that. And so, the first few years, actually several years, I was just working in litigation, pulling 100-hour weeks, losing years off my life, being this is not what I want to do the rest of my life. And so, how I got started actually in ventures, I just literally moved from San Diego to Los Angeles and hung a shingle and started working with founders really from the ground up, because those who's going to hire a non-big law firm attorney is you got to kind of start somewhere. And so I had a few lucky breaks to the point where in 2016, 2017, I was able to work on some funds, and got a really lucky break in 2018. 2 things happened. One, I started working with funds a little more regularly and started really getting, actually used to the workflow, and realizing it actually wasn't as difficult as it seems. Because once you do a handful of these, you kind of see like it's actually not that difficult, right? Startup law, there's like a lot of complications on the corporate side, but when it comes to fund work, you're dealing with a lot of partnership and things that are pretty easy. But another lucky break I had was I linked up, and so he was like an early partner at Cooley. And the story we always say is his first two associates, Mr. Gunderson and Mr. Detmer. And so he kind of, he's been around the horn, and he's really taught me from a structural perspective, how to think about just like the bigger stuff that you just don't really get unless because being an attorney is really an apprenticeship. You gotta learn from someone who's done it before, pave the path. Because if you're doing it on your own, good luck. Good luck. So yeah, that's probably.
That's incredible.
Sure that's
oh wow! Well, cheers to him. I'm so glad that he's helped you, and also that you're now able to help all of us be better at what we're doing too. So thank you so much, Chris. Really appreciate it.
I agree. Second that, Chris, you've been one of the most helpful professionals that we've worked with since starting this fund.
No question.
Thanks, guys. Thanks for doing this. I definitely appreciate it. It's all about increasing the awareness, and so everyone's on the same page, and so we close the deal and get on with their lives, right? Because no one wants to be stuck trying to figure this out when they're actually going through the deal. That's not the place you want to be.
Absolutely.
All right.
Well, thanks so much again, Chris.
Okay.
Yeah,
really
thanks so much for joining us.
Okay,
cool. I'll sign off. Yeah, this has been Beers with VCs with Chris Harvey, the emerging manager attorney, signing off. See you next time. Cheers.
Cheers.